That collapsed the day Lehman Brothers collapsed. And with it became the start of the global economic crisis, and not just a global financial crisis. Just to give you a sense of how big that global growth crisis was, if we look at the dramatic declines in output, in GDP growth, that took place in just a very short space of time, in the space of 5 quarters only, we saw growth rates globally collapse, as we know. In the US, the peak of GDP growth occurred in the 4th quarter of 2007, where growth was, on a year-over-year basis, just over 2%. 5 quarters later, it was minus 4%. So a near 6% decline in year-over-year GDP growth in just 5 quarters. And as we start to look east and look at the impact of the financial crisis and the economic crisis on markets in Asia, we see an even more dramatic decline in output. When we look at Malaysia, 4th quarter of 2007, in year-over-year terms, the Malaysian economy was growing at a 13% year-over-year pace. 5 quarters later, the Malaysian economy was contracting at an annual pace of 6%. So a 13% decline in year-over-year growth in just 5 quarters. This is a dramatic decline in growth. And it's dramatic in a historical context, and it's dramatic in the sense that it was synchronized across the world. But this is not just a crisis in terms of a decline in output. When you look at the US market, this is a jobs crisis as well. This is an environment where we've seen the biggest increase in unemployment in nearly 30 years. This is the first recession, if you like, since the 1980s, where a sustained decline in output has led to a dramatic, and I mean significantly dramatic, decline in employment. Unemployment rate now in the US is 10%. We've seen 8 million jobs lost in the US in the last 18 months. And the IMF estimates that those 8 million jobs are possibly lost permanently from the US economy. It may well take 5, 6, 7 years before the employment level in the US gets back to its pre-crisis level. That's how big an impact on labor markets, the financial and therefore the economic crisis, has had on the US economy. Two years ago, I was often asked the question, do you believe in the story of decoupling? That is, Western Hemisphere markets, those economies decoupling from economies in the East. And I spent a lot of time and a lot of effort telling investors at that time, definitely not. I think the experience of the last 18 months, I've got quite a lot of things wrong, I have to say, in the last 18 months. One of the things I think I got right was going back and telling investors just how wrong they were to assume decoupling was going to take place. What I show on this chart here is the output of industries in a combination of Western developed markets and the similar average output in Asian markets. And you'll see a relationship that's held now, certainly for at least 12 years, where output in industrial activity in both parts of the world move in lockstep. Nothing about the growth in China, nothing about the emergence of India as a global economic powerhouse has changed that story. But what has Malaysia's experience been during this financial crisis? Well, given the export-oriented nature of the Malaysian economy, the open nature of the Malaysian economy, clearly it was going to suffer as global trade collapsed. And we can see that in the GDP numbers, and we can see that in the export numbers in the top left chart, where we've seen, as we move from 2007 and into 2008, a dramatic decline in output and a dramatic decline in export growth, just reflecting how important growth from a global perspective is for the Malaysian economy. Policy response, though. Central bank has been swift and aggressive in its response to the financial crisis, cutting interest rates from over 3% to 2% during the course of 2008. And not shown here, but we know well the stimulus package that has been announced, the 2 fiscal stimulus packages announced by the Malaysian government, amounting to something like 9% of GDP over the course of the next 2 years. I think what's important for the Malaysian economy as well, and something that I believe holds the economy in good stead for the rest of this economic cycle, is the extent to which the impact of China and the growth of China is increasingly having a positive impact on the Malaysian economy. If we go back 10 years or so, exports to China from Malaysia made up about 5% of total Malaysian exports. We move forward to today, that number has more than doubled to nearly 10%, over 10% of total exports. And at the same time, I think quite crucially, the percentage of exports leaving Malaysia and going to the US and Europe has fallen quite dramatically as well, from 15 to 20% now down to 10%. I believe by the end of this decade, the single most important export market for Malaysia will be China. And I think the equity market believes that as well, because the bottom right chart shows you how the Malaysian equity market has performed relative to global equities over an extended period of time. And we can see quite a dramatic degree of outperformance of the Malaysian equity market relative to global equities, particularly in the last 12 months. And I believe, amongst other things, that reflects the resilience of the Malaysian economy and the extent to which the Malaysian economy now is far more dependent than it was historically on growth dynamics in Asia and less dependent on growth dynamics in the US and in Europe. It's a positive, and I think it's a positive that will live and drive the Malaysian equity market for quite some time to come. The words unprecedented are used quite a lot with regard to the financial crisis, sometimes inappropriately, but I think appropriately when it comes to thinking about the synchronized nature of the policy response to the financial crisis and the ensuing global economic crisis. The major central banks around the world have moved in lockstep to stimulate growth by significantly reducing interest rates. The 4 charts here show the central banks of the Euro area, the US, Japan and the UK, all slashing policy interest rates to their lowest ever levels in some instances. This is unprecedented for 2 reasons. One, as I said, because the level of interest rates that prevail around the world now is at a historic low, and the extent to which this has been done in a coordinated and synchronized way by different central banks. But as interest rates get cut to zero, as we know, we've seen innovation in monetary policy by a selection of central banks in the form of quantitative easing. Now, frankly, I didn't know what quantitative easing was going back 2 or 3 years, but clearly it's become an important mechanism, an important tool that central banks have used to try and stimulate growth. I wanted to share with you exactly what quantitative easing is, if you're not sure. A central bank will buy from an institutional bank assets. The central bank will just print money or create money to buy those assets from the central bank, in the hope and expectation that that increase in money and reserves now held by banks will be used to create credit and create loans for businesses and for individuals. So when interest rates reach zero, the only other policy measure available to central banks is through the direct influence on the growth of credit. And that's what central bank in the UK, central bank in the US, and central bank in Europe have tried to achieve through this policy of quantitative easing. What they've done is buy bonds from banks, and that's had another positive impact, because what that did was, through central banks buying bonds, it brought and lowered bond yields. And lower bond yields meant easier monetary conditions. It meant it was easier and cheaper for companies to refinance themselves, creating another boost to growth and another boost to activity. Unprecedented, not only monetary policy synchronization, but unprecedented fiscal policy synchronization. Almost every major economic region and every major economy has engaged in fiscal policy stimulus, either through government expenditure on infrastructure plans or on supporting labour markets, or through tax cuts. The degrees to which different economies have applied different degrees of stimulus is interesting, and I think will reveal itself in different growth rates in different parts of the world going forward. But we can see in the US quite a significant policy stimulus, something like 4 to 5% of GDP has been promised, half or so has currently been delivered, another 50% of that stimulus to come in 2010 to boost growth, to secure jobs in the US economy. As we look in Asia as well, even greater plans to boost growth through fiscal stimulus are in place.